Welcome to Yahoo Finance Live. I'm Julie Hyman along with Josh Lipton. We're here at the New York Stock Exchange, bringing the big three at 3, the top 3 stories as of 3 p.m. We start with markets, which have been somewhat on edge ahead of tomorrow's government jobs report. Rates holding steady around 4.7%. And San Francisco Fed President Mary Daly suggesting the Fed may not need to raise rates because of the tightening bond market.
Plus, General Motors shares sinking to a 3-year low. The Wall Street Journal reporting that the automaker has at least 20 million vehicles with potentially dangerous airbag parts, and the government says vehicles with the parts should be recalled before anyone gets injured or killed.
And the Biden administration reversing course on the border wall. The government will now allow construction on the wall along the southern border in Texas as Democrats face pressure to address the immigration crisis. We'll have the latest on Biden's plan later on in the program. But first, let's get you up to speed on the market action, or in today's case, the lack thereof. We are not seeing much movement for the major averages at the moment, but we've seen them bouncing around between gains and losses throughout the session here. Right now, the Nasdaq is the big gainer of the day, but it's up just 0.1%. The S&P barely changed here, as is the Dow, which is up by just 23 points. If you take a look in the bond market, which of course has been the tail wagging the dog as of late, we don't see a lot of movement there either, but still backing off from the 5% that 30-year yields had approached, now at 4.88%, the 10-year at 4.71%.
Mortgage rates continue to climb. That's dimming affordability for potential home buyers. Shifts in inflation, the job market, and uncertainty on the Fed's next policy move, all contributing to elevated mortgage rates. No supplies, Julie. Mortgage rates go up. Mortgage applications go down. Obviously, a lot of people now push to the sidelines because they just can't afford it.
Yeah, so we have this sort of paralysis or freeze in the housing market in some quarters because of all of this. And it's interesting, just like the prospects for economic growth and the view of it have changed so much since the beginning of the year, so too has the outlook for mortgage rates. There's a story on the Yahoo Finance platform today quoting an economist at a real estate provider who said, at the beginning of the year, we were talking about mortgage rates falling to 6%. Now, we're within spitting distance of 8%. So it's really changed as the outlook for the economy has changed to reflect more strength than people anticipated, and therefore higher interest rates from the Fed than people had anticipated. All of that pushing up those mortgage rates.
Yeah, so on one hand, supply, no inventory. Limited inventory is how they put it. There's no inventory. And demand, of course, has just crushed affordability. So you appear frozen, and you wonder what breaks that through.
Well, we're going to talk about that later on in the hour.
Guest.
Yes, that's right. The CEO of Redfin is going to be joining us to talk about all of that. I know this is a topic close to your heart,
very
Josh
personal
Lipton,
to the Lipton family. Yeah. We're renting for life, Julie. That's what I've come to grips with.
No,
it's fine.
It's going to happen.
I made my peace with that.
It's going to happen. You're going to find something. All right, let's get more into what's going on with the markets, not just today, but what we've seen as of late. The S&P 500 is still higher this year, but it's lost more than 7% since the end of July. Our next guest has been one of the stalwart bulls on the street. Has the recent selling made him change his tune at all? I suspect not. Joining us now is John Stolfus, Oppenheimer Chief Investment Strategist. John, it is fantastic to see you as always. It's my understanding you still have that 4,900 target for the S&P 500, which is looking further away from here. What gets us there here? What are the silver linings that folks are missing, maybe?
Well, first of all, great to be on the show with you, Julie. The first thing is when we put the 49 target in, we put that in at the end of July as our 4,400 target that we put in for the S&P 500 last December had been exceeded. We had closed over 4,400, and so we had to do something with it. And we thought if we left it at 4,400 at that time, it would have seemed bearish to some. If we'd only raised it to 4,600, it wouldn't have been much of a jump from that level, because at the end of July, I just checked, the S&P 500 was at 4588. So the 4,900 target at that point looked like about 6.8% upside from that. So we were allowing for some kind of pullback in the fall. Be careful what you wish for, right? But when we look at it, we'd say the 4,900 looks like it's still very possible. What we have to take into account is what's caused the market, in our view, to go through this tizzy that it's going through. Combination of seasonality, There were various options expiries that also occurred. Still a lot of people, who are in their 30s today who are only 15 the 2008 crisis, financial crisis. So all they've known is low interest rates. My first mortgage was 10%. If I could have gotten a 7 or 8, I would have just been thrilled, believe me. And my boss's first mortgage was 16%. And I recently ran into somebody who had an 18% and a 20% mortgage. We all survived, and so did the real estate market. But when it comes to where we are today, we've got to think that the numbers tomorrow could help some. If that jobs number comes in hot, the market's going to get rattled. If it cools off too much, the market will say, oh my gosh, we're going into a recession. If we get a Goldilocks number, we'll probably gain to close the week higher. But we are expecting that here in October, we'll get some kind of calming when the market realizes that the end of free money is a good thing. We've had years where bond issuers have not paid for the privilege of borrowing money because interest rates were set to emergency standards by the Fed, whether it was the financial crisis or the pandemic. And with the pandemic, we had turbo fiscal policy stimulus. And now we got to go back to a more normal time. And how nice for bond buyers to actually get coupons that are fairly decent, especially when you've got so many baby boomers moving towards retirement.
And John, so first of all, as a prospective home buyer, I'm no longer going to complain about 8%. You got me out with 10%. You put me in my place. I'll stop fetching about that. But John, let me also ask you, one potential catalyst, of course, will be earnings season. We're gearing up for it. There are some bulls, John, who think that's going to move us higher. What are your expectations for earnings season, John?
We're looking for positive surprises once again in Q3 earnings season. We must say that Q2 earnings season was positively surprising. When you looked at the sectors individually, there were only, as I recall, on my Bloomberg terminal, it showed only 3 sectors had negative earnings growth in Q2. That was energy, healthcare, and what the heck? What was the third one? One that you might not have. Materials. It was energy, materials, and healthcare. All the others were positive, with industrials and consumer discretionary actually double-digit earnings growth. So we might see something that'll surprise in the Q3. Analysts are certainly looking for a better performance here. And we'll go along with that, particularly because technology has enabled companies to navigate tougher periods better than ever before. And a lot of companies came in with longer-term debt. So this near-term relative highs in interest rates compared to where we were likely may be very digestible if the Fed indeed pauses as we get towards second half of next year.
And John, it seems to be the consensus is changing that the Fed may even pause before then because of higher rates. In other words, that what's happening in the bond market already is sort of doing the Fed's job for it. Do you think that's the case?
Oh, I think that is very possible. I think the bond market certainly has chipped in here. I think the bond market got too negative here in terms of the sell-off in bonds. Near term was a little bit deeper than we would have expected. But once you have a sell-off, you always expect things to go too far. So where we are now, we think, based on the fact that we think we're going to have a better earnings season, and we think the Fed has been extraordinarily sensitive, really showing its Bernanke legacy to the effects of its mandate in this Fed funds hike cycle since March of 22. When you look at it, there was the aggressive part was 4 consecutive hikes of 75 basis points each. That was the big aggressive part. Since then, it's been, I think we had one more of 50, and then it's been 25s and 2. What do they call it? They don't call it a pause. They call it a skip. So I think the Fed is showing us, even though it's making very big, very loud noise about it needs to get back to a 2% inflation rate, it certainly has taken a path that shows sensitivity. And I think the bond market will get that too. Hopefully it won't overbid bonds at that point, bring bonds too low. But we can't help but think it's a normalization of interest rates, and we think it's a good thing.
Hey, John, final question for you. I'm just interested. What do you make of those investors who might be listening right now and they're saying, you know what, I'm going to sit tight in cash? T-bills, money market funds, John, yielding 5%. Some are thinking, I can sit tight, sit on my hands, be patient. Is that a smart strategy?
It really depends upon the investor's particular needs, their tolerances to risk, how experienced they are related to equities, and how they are in terms of historical context in terms of equities. I would have to think you're better off diversifying. And if you've got enough experience with the markets and your needs and objectives fit, you're looking for intermediate to longer term. This looks like a good time to pick up babies that have been tossed out with the bathwater, babies who've been ignored, good companies in this. And we had a broad rally from October 12th of last year through last Friday, for example. But from the start of the year, it's been a very narrow rally, making a big deal about the seven, the big magnificent seven and all that. But we'd have to say that whether it's ignored stocks that are really quality companies that are profitable with good cash flow, or babies that got thrown out with the bathwater, companies that had been recognized and got beaten up on the downdraft, we think you want to look for those, because stocks generally on a historical basis perform, past performance being no guarantee of future results. But the reality is stocks are over the intermediate to long term have shown that they're a better place to be for most investors than all fixed income.
John Stolfus from Oppenheimer, thank you for your time today, sir.
Thanks, Josh. Great seeing you. And great seeing Julie.
Oil prices closed lower during Wednesday's session as fears around demand destruction seep into the market. For more on oil markets, where we're joined now by our very own Inez Ferre. Inez.
Yeah, Josh, right now we are taking a look at WTI and Brent crude, which are down more than 2% for the session today. This is after the 5% selling that we saw yesterday. So investors taking some profits here. And of course, a lot more talk about demand destruction kicking in. Now, yesterday we did have that data from the EIA saying that gasoline seasonal demand levels were at their lowest for the last 25 years. So that spooked the markets. You also had Saudi Arabia and Russia that confirmed that they were going to continue on with their supply restraints through the end of the year. But that wasn't really a surprise to the markets. Now, RBC Capital did come out with a note saying that these analysts believe that Saudi Arabia will continue with those unilateral production cuts of 1 million barrels per day into 2024. Keep in mind that RBC is the same firm that also said that crude could go to $100 a barrel if momentum continues, but also said that, look, the markets tend to overshoot and then overcorrect. So we may be seeing some of that correction happening now. And I've heard from both camps regarding where oil prices are headed. There are some who believe that, yes, they could go to $100 a barrel unless China implodes or unless we have a big recession. And then others that say these levels are just unsustainable. Citi saying that they are going to go back down to the low 70s, that you can't sustain these levels once they get past $9 a barrel. I will leave you with this. Gasoline prices, those are expected to continue their downtrend. They have been coming down recently. Gasoline futures are down. And Tom Closa over at Opus believes that you are going to see at the pump prices down anywhere between 25 cents to 50 cents a gallon. Now, the saying goes that prices go up like a rocket, they come down like a feather. In this case, he's saying that these are wet feathers. So this will be a noticeable decline.
Wet feathers.
Wet feathers. Inez Ferre, thank you so much for that. Great stuff. Appreciate it. And shares of Rivian plummeting today after the EV maker revealed it will issue $1.5 billion worth of convertible notes. Company also issuing preliminary third quarter estimates that show sales will be slightly lower than expected. So it's been a wild week for Rivian, Julie. But on the preliminary Q3 revenue, so they expect a range of 1.29 to 1.33 billion. Street was at 1.3 billion, and then they're going to issue 1.5 billion convertible debt. So they're looking to raise cash.
And they need the cash because they are still losing money on every car that they make. Now, as we've talked about with even the bigger automakers haven't necessarily gotten that mix right. They still lose money in some cases on their EVs as well. But I mean, to your point, it hasn't just been a wild week. It has been a wild all of its public existence for this company, right? I mean, yeah, the year to date, it's actually up shockingly, but it's down more than 40% over the past year because investors sort of can't figure out what to do with this thing. Is it eventually going to gain more critical mass? Are they going to make money on the cars? Are they going to sell more of them and therefore trickle through to the bottom line? I think that a lot of investors are still really struggling with this. I was just looking at the short interest on the stock, which is about 12% of float. So still relatively high short interest of people who are not confident in the story here.
They are losing money on every vehicle they sell. Now, you can, of course, make that up if you sell a lot, but that takes time.
Exactly. So we'll see what ends up happening. Let's stick with automakers in terms of movers we're watching. General Motors on the list. Those shares are off by more than 3% and at 3-year lows. Now, that's after a Wall Street Journal report revealed at least 20 million vehicles were built with a potentially dangerous airbag part that the government says should be recalled. Now, this is an ongoing issue that the government has been looking into. These parts made by ARC Automotive, which has pushed back against the government's criticism of the parts. And GM's not the only automaker that has them in its cars, but this new journal report, when you see the number 20 million vehicles, if indeed there ends up having to be a recall, that's obviously a large number.
Yeah, and the journals point out the number of affected GM vehicles. That hasn't been disclosed publicly yet.
Right.
But you think about the headlines. I mean, this is just about the last thing GM needs right now with, of course, the ongoing UAW strike that shows no end in sight.
No, and if you look at the 20 million for GM, what the journal is saying and what regulators have said is there are 52 million overall airbag inflators made by this company, ARC Automotive, that could be faulty. As I said, the company's pushed back, and so NHTSA, the National Highway Safety Transportation Administration, has called for public hearings and has been holding them on this issue to try to press it. So, in other words, there are still more developments to come in this story.
Yeah, rough headlines. Shares of Lamb Weston Holdings, let's check that out, rising today. Nice pop, nearly 10% after the company's first quarter earnings beat on the top and bottom lines. The frozen potato producer also raising its fiscal guidance. So frozen potato products, Julie, that's what we're talking here. Earnings beat, boosted the earnings forecast, nice jump in volume. And some analysts I know are saying this was encouraging given what they see as that weaker restaurant trend. So they like what they heard here.
Yeah,
and so do investors.
Frozen fries, frozen tots, all of your favorite frozen products. They were also raising prices. And it looks like, even as we maybe come to the limits of some of those price increases for some products, we're still seeing pricing power among others. And it looks like perhaps that Lamb Weston and frozen fries are still one of those areas.
Frozen potatoes.
Yeah, when's the last time you bought frozen potatoes?
Oh, that's a staple in the Lipton household.
Is it?
Tater tots?
You're into
Come on.
the tots? I do love the tots as well.
All day long, 24/7.
All right. Well, I guess we're helping Lamb Weston. All right, we're just getting started here on Yahoo Finance Live. Coming up, housing hurdles. Mortgage rates continue to trend higher. What will it take to see that market thaw? We're going to break it down with the CEO, Redfin. And diploma dilemma. Will AI make having a college degree less valuable in the future? We'll hear one side of that argument. Also, streaming sports. Warner Brothers Discovery launching a new sports tier on its Max service today as the company tries to lure more users. We'll hear all the details when Yahoo Finance comes back. Investors are waiting on the jobs report tomorrow, and it's one of the key economic reports that drive market moves. Jared Blitkery is on the floor of the New York Stock Exchange. I got to tell you, Jared, it certainly feels like people are waiting today for the jobs numbers tomorrow morning.
I know I am, but I'm happy to share my thoughts on what will happen tomorrow morning at 8:30 a.m. Let's go to the Wi-Fi Interactive. I have prepared a chart going back 3 years, roughly to the beginning of the pandemic, those pandemic lows in March of 2020. And I've charted the S&P, 500 Spider ETF. That's in purple here. I'm just kind of tracing it out. But there's basically three different things moving the market in terms of economic reports and other big macro events, besides earnings, because that's on a company level. You have inflation, which is CPI mainly. PCE is important too, but it doesn't seem to move the market as much. CPI comes out a couple weeks before that. And also the jobs day. We're going to get those big employment numbers from the BLS tomorrow. I have, for instance, in red on this chart, this is what would happen if you invested only on jobs days, the day before to the day of, close to close. And in this red line, you can see we actually peaked right around the time the S&P 500 was making its lows last October, and we've come down, or excuse me, those are Fed days. I got that backwards. So Fed days have been negative. CPI days are in orange, and those are actually the most volatile. And in cyan, in light blue here, we have what's happening on the employment days. So since the beginning of this year, we've edged up ever so slightly. The last few reports, we haven't had that much of a big of a reaction off of that. And I think that's because there was no narrative changing elements to it. Tomorrow, and this is what I was arguing yesterday over my interview with Macro Alf, if we get a really hot report tomorrow, like payrolls is 500,000, wage growth is accelerating, we're probably going to see a leap higher in bond yields. That means bonds themselves are going to sell off, and we'd probably see equities take a little bit of a hit there. But if we got a negative payrolls tomorrow, the flip side of that, a really bad report, guess what? I think recession would start getting priced in right away, and there's none of that right now. So it'd be one of those hand smacks the forehead moments. Well, we got to price this in, and you'd see markets take off to the downside. If there's nothing really too hot or too cold about it, let's call it the Goldilocks report for lack of a better term, then probably not that much of a reaction. And I think the market will just look ahead to earnings because we get JP Morgan kicking that off next week. But bottom line, anything to the upside in terms of hot numbers or the downside could move the needle, but I think we're probably going to just come back in line. And tomorrow, Julie, we might be saying, well, we're waiting for JP Morgan, waiting for JP Morgan's earnings next week as well.
Jared Blitkery, thank you for that. Surging bond yields are making investors nervous, including, of course, tech investors. But our next guest says he's using the macro and Fed worries as a time to double down on his bullish tech thesis and not panic. Joining us now to talk about this is Scott DeWitt from Wedbush. Scott, great to see you.
Hey, Josh, how you doing?
So, Scott, let me just start right with the big story for investors right now, those surging bond yields. And typically, of course, Scott, you would think that's a headwind for tech, for growth-oriented stocks. Do you think tech stocks, can they work, Scott, against that backdrop?
Probably not. I think that you're going to need, the combination of rates and oil to decline and some, less pressure on the economy to get growth stocks to really start to work again in an environment where rates are rising. So the scenario that in the segment that preceded me in terms of jobs report being strong, the economy remaining hot, I think that's a knee-jerk reaction that's negative. Even though a stronger economy for a long period of time could mean greater growth and greater profits for growth companies, I think just the surprise around that and the pricing end of that initially would be negative. But our view is that ultimately we're closer to the end, very close to the end of the rate increases, and that when we get to the other side of that, whether that's imminent or in coming months or coming quarters, it's going to be a strong tailwind for growth stocks.
So in other words, Scott, hey, it's Julie here. In other words, even if there's a little pain to come, if you're interested in tech stocks, you should buy them here, wait it out, and then sooner rather than later, maybe, whether it's weeks, months, you will have that rebound that you're talking about.
Well, I think coming out of the pandemic, there was a case being made that these large growth companies were at secular maturity, and you had a very weak year in 2022 for stock performance. And I think these businesses have proven that they're resilient, that the underlying growth is still there, and that 22 was more of a digestion period on the back of the pandemic. And in addition to that, you have an AI cycle, which is just beginning. And so I think that whether we go down first or we go straight up, we're going up, because these companies have proven themselves in terms of continuing to be secular growth stories. And we have another cycle that we're in the first inning of in AI. And so we're very optimistic on the group overall across my coverage and internet, as well as the broader tech team at Wedbush.
And Scott, you mentioned there AI, and of course, big tech's been putting a lot of time, effort, and money into that technology. I'm interested, Scott, in your coverage universe, what are the names that you think are best positioned to monetize generative AI?
So I think first and foremost, it would be Amazon and Alphabet. Amazon because of the cloud business and the ability to integrate services into their cloud offering that corporates adopt, that then creates a monetization cycle for AWS, and similarly, Google's compute engine as well in its business. So those two companies, to me, are the clearest beneficiaries of this next coming cycle. But companies that are not, quite as obvious, like Booking.com, in terms of targeting and other features and functionality that can be expanded because of the use of large language models, I think that will come with time. But where we are in the cycle right now is NVIDIA is making all the money. Everyone's buying the chips, and it's going to go from the chips to the cloud providers figuring out how to monetize the use of those chips. And then in coming years, it'll be more clear and evident which consumer companies benefit. I have the joy of covering companies like Amazon and Alphabet that cross over those two. So it will be the corporate enterprise side of Amazon and Alphabet that show it first. But when you look at the consumer businesses as well, in the latter portion of this cycle, I think you're going to see their ability to monetize there as well.
Scott, just one follow on AI. As you watch big tech, these companies that you cover so closely, and they integrate AI into their tools and products, Scott, is there a risk that technology becomes commoditized, in your opinion?
I think that it's possible, but I think that it's many years in the making in terms of AI will be a premium product offering as it relates to cloud service providers. And if anything gets commoditized, it's the infrastructure layer of cloud services, not these new tools that corporations are testing out. And I think the argument that I think that would be made negatively as it relates to consumer companies is that nobody knows exactly how to use these tools. So it's unclear whether and what the ROI is going to be for the investment for companies that are going to be buying these services from the cloud providers and otherwise. And so I don't think of it as like it being commoditized. I just think that there's not yet a clear path in terms of who wins in terms of the consumer-facing companies, and in fact, what those returns are, because you don't even have these offerings productized yet in consumer offerings. We're optimistic, in terms of each of the layers of this, the chip sales and NVIDIA beneficiary, the cloud companies and the consumer companies, but I think it's going to take time to figure out what the winners are going to be. We're at the top of the first inning with this.
And Scott, I know one of the other stocks you like is Microsoft, and I wonder, you're talking a lot about the consumer-facing opportunities in AI, but obviously there are also a lot of business-facing opportunities in AI that also, similarly, we don't entirely understand yet. Is Microsoft partially a bet on that side of the story?
It is so similar, and Microsoft is covered by Dan Ives here at Wedbush, but the underlying drivers are very similar to what I talked about with Amazon's AWS and Google's GCP product offering. Microsoft was kind of first to create a relationship with the leading company in AI, which is OpenAI and its ChatGPT platform. And so it's very well positioned and seems to be so as we go into this next revolution. And Dan has an overweight rating on the stock, and I'd say that the view is consistent with my view on Amazon and Google in terms of it being a driver of stock performance in coming years.
All right, a little bit of calm here for those who might be overly worried about the rise in rates. I should point out the Nasdaq's still the best performing of the three major averages by far on the year. Scott Devitt, thanks for your perspective. Really helpful for investors today. Appreciate it.
Thank you.
Up next, mortgage rates are on the rise. When will home buyers see relief? We're going to ask the CEO of Redfin after the break. Mortgage rates continue to rise. The 30-year fixed-rate mortgage hitting 7.49% on average last week. That's according to Freddie Mac data just out today, and it's a 23-year high. This coming as mortgage applications have ground to a halt. According to the Mortgage Bankers Association, applications there dropping to the lowest level since 1996 as that rapid rise in rates pushes potential homebuyers out of the market. Joining us now, Redfin CEO Glenn Kelman. Glenn, tell us, when is the dam going to break here? What is going to change these dynamics?
Well, I don't think we're going to get a major break in the action until the Fed lowers rates, and that's unlikely to happen in 2023 or even in the early part of 2024. So this is different than other housing market downturns. In 2008, there was massive distress. People didn't want to sell, but they had to, and that brought prices tumbling down, both through foreclosure and short sales. This time around, it's a standoff. No one wants to sell their property. No one wants to buy a property. So sales volume is going to stay low for the foreseeable future.
Yikes, Glenn. This is sounding grim. Here's my question. As mortgage rates, though, they keep going up, Glenn, at some point, would you expect home prices to start falling here meaningfully?
Maybe some. So far, that trend hasn't happened. Inventory is down 15%. We have seen an uptick in listings just in the past few weeks, so maybe that'll show up in broader industry-wide numbers later in the quarter. And if that happens, then we could see some softening of prices. But right now, there just aren't enough homes to buy. And if I had to say where we were more short, it would be on the supply side, not on the demand side, although both are really down.
None of this is news that Josh Lipton wants to hear, Glenn, unfortunately.
Brutal, Glenn.
Yeah,
Brutal.
Josh has been looking for some sunnier news on this one. Talk to me about sort of the different tranches of the housing market, because I'm curious how this is playing out with starter homes versus higher end homes, et cetera, or is it kind of all in the same boat right now?
It's fairly broad. I would just say that well-priced homes that are turnkey are still selling. So if the property needs some work, that's unlikely to appeal to someone who has already maxed out because of mortgage interest rates. And so we tell people to really get the property fixed up. And that's another difference between now and 2008. In the last downturn, people were really buying on square footage alone. This time around, the sellers are really trying to gussy up the house to make it look good. At the lower end of the market, it's a better market. At the high end of the market, we're really seeing properties sit for a very long time.
Yeah. Glenn, we're talking about the housing market nationally. I'm also curious, though, regionally, Glenn, as you look across the country, are there regional differences that are worth noting?
Sure. So Chicago is doing better. Florida is doing better. Texas has mostly been doing better. It's the West that's really struggling, and especially Oregon and California. People are fleeing high-tax states, and that trend has mostly not reversed. In Washington state, there has been a change in the weather just because some people are being brought back to Amazon and Microsoft. There are also people who feel alienated by the politics of Texas and Florida and want to come back to a more left-wing state. So for the first time, we are seeing some people coming back to coastal markets, but mostly the damage is concentrated in California, where it's really been a problem for the past 4 years.
And Glenn, we were joking about this being a bummer for Josh, who's looking for a house. I mean, it's not great news necessarily for your industry either, right? Redfin suffering amidst this to some extent, although your stock is up on the year. Are you all also looking for this turn in the housing market?
Well, you have to build your business for the economy you're in rather than hoping for a different one. So the only way Redfin is going to grow is by taking market share. So we're drawing visitors away from other real estate websites. We're getting more people to ask for tours as a result. But the problem is that once those people see how far their money goes, many of them change their minds. So we just need to drive that through to a sale. And at some point, we're just going to need some help from the overall economy. And it's really a tragedy at a generational level. At this point in their trajectory, baby boomers owned more than 30% of national wealth, whereas millennials own less than 20%. 1 in 5 millennials believes he or she will never own a home. And so I think we're just in a situation where sooner or later, government, the Fed, society as a whole is going to have to decide that housing is really important to the economy and that housing is really important to family formation and society overall. And so it's a basic human need at 4 million units instead of 6 million. Redfin is still going to take share. We're going to be just fine, but it's more competitive than ever. And maybe one other change that's interesting to me is just how price competitive real estate agents have been. I mostly have felt that this industry is completely resistant, to change. But over the past 6 to 12 months, I have never seen more discounting among traditional brokers than now. So that, coupled with some class action lawsuits in Illinois and Missouri and other big changes threatened by the Department of Justice, means that this whole industry is up for grabs in an exciting way that I haven't seen since starting at Redfin 18 years ago.
Glenn, my last question to you is, who is actually buying homes, though, Glenn? Do you all have data and insight on who is actually getting the deal done and moving into new homes? Who's my competition, Glenn? That's what I'm asking.
Well, Josh, didn't you relocate from San Francisco to New York? Is that why you're looking for a house?
It's great memory, Glenn. I did. I'm here in New Jersey, and it's brutal, Glenn. There's no inventory. You hear limited inventory. It's what my grandma Minnie would call bupkis. That's what's out there, Glenn. There's nothing. And affordability, as you know, has been crushed.
I had no idea you were Jewish, Josh, but You are one of many people who are relocating across the country. So about 18% of our customers used to be relocating, and now it's 26%. So aside from death and divorce, which is always going to be one reason people trade homes, the other big issue is that there's still unfinished business in America where people want to leave one state for another, often to flee taxes. And so as a result, we are still going to see this millennial generation want to have kids and buy houses for their families. We're still going to see this relocation. There's a bunch of social forces that are driving significant demand. It's just sidelined right now by rates. The rates are sidelining the inventory, and the rates are sidelining demand too. So it'll be a standoff.
Glenn, thank you for stopping by today. Always great to see you, my friend. That was Glenn Kelman.
Yeah, bupkis.
Warner Brothers Discovery is trying to lure more viewers to its Max service, and sports is shaping up to be one way to do it. Yahoo Finance's Alexandra Canal has the details for us. Allie.
Hi, Josh. That's right. You can officially watch sports through Max with the Bleacher Report add-on. This is going to be free to subscribers until March 1st. At that time, all Max subscribers will then have to pay $9.99 for that add-on. So just in time for March Madness, you're going to have to pay up a little bit. But the add-on does include access to live games from the MLB, NHL, NBA. In addition to other major sporting events like March Madness, subscribers will be able to access TNT's popular Inside the NBA Studio program, along with select international games. And Max has said that they want to have 300 live events available to those subscribers to this package. And it comes at a time where Warner Brothers Discovery has been heavily leaning on different types of live events. We just saw CNN Max, which was that 24/7 live streaming channel, be added to the platform. Analysts have said that live content, it creates an element of stickiness that really keeps those subscribers coming to the platform, staying in that ecosystem a bit longer. And we're seeing sports be a really big driver for many of these streaming services. We know that Disney is going to launch ESPN fully over the top as a direct-to-consumer streaming service over the next few years. We've seen Peacock really leaning into sports as well. Apple reportedly going after F1 rights. So this is just something that's becoming more and more apparent as the race for content escalates, but different types of content than we've seen in the past. Before, it was really all about original series, catalog shows. Now we're seeing that live element start to become more and more attractive as these platforms really look to profitability, and they look to have a more engaged subscriber moving forward. So certainly if you're a sports fan, there's a lot to look forward to, and now we have that on Max.
Yeah, a lot of choices. We'll see which things people choose going forward. Allie, thank you so much. Appreciate it. Coming up, the Ozempic, Wegovy, Mounjaro craze. We're going to break down what the rising popularity of these diabetes drugs could mean for American food giants. That's next. Diabetes technology vendors seeing their stocks under pressure in recent weeks amid growing use of weight loss aiding drugs. Here to break down the details, Yahoo Finance's Anjali Kamlani. I mean, Anj, we've been talking about this for a while, and it just feels like the drumbeat is getting bigger and the ripple effect is getting wider.
Yes and no. So definitely starting to see a lot of attention and focus more on what exactly the fallout is going to be of this increase in use. We know that, of course, use is still limited by insurance and by employers willing to pay for some of these drugs. But what we do know is that with their rising popularity, there has been concern about certain companies being impacted. That's insulin pumps, that's continuous glucose monitoring, and other medical devices. We've also seen reports of decrease in bariatric surgery. So all of these things just sort of feeding to the idea, of course, that these drugs are getting more attention, more people willing to try them. At the least, Ozempic for type 2 diabetes and Wegovy when it was made available for weight loss. But we've seen also a little bit of reversal of that concern. You're seeing from Jefferies some notes that give you some idea of that. One note said, quote, "We only see potential for a modest drag or no drag on the insulin pump opportunity and view that opportunity for continuous glucose monitoring as unimpaired or even helped by GLP-1s. Those are those semaglutide, Wegovy, and Ozempic drugs, as well as Mounjaro. And those drugs are actually helping to enhance monitoring and help those patients actually continue to do a better job of being compliant with their use. There have been, of course, some studies that have looked at whether or not eventually over time, diabetes patients would be weaned off of insulin as a result of use of these. But there's also others that look at bariatric surgery paired with Ozempic and the benefit there. And the opportunity for type 1 diabetes is not impacted by these drugs. So there is still opportunity for these. In another note, Jefferies cleverly called these stocks that have been under pressure as being in quote unquote GLP-1 jail, saying that given sentiment overhangs around GLP-1s, we are realistic in thinking it may take some time for these stocks to be released from quote GLP-1 jail. So, with, of course, the frenzy of interest, we're starting to see some of that waning and sort of some of that reality check sort of playing a role.
And Anjali, related to these weight loss drugs, there have been these findings from the JAMA Medical Journal pointing to some health risks. What can you tell us there?
That's right. Ongoing look at long-term effects of these drugs or how exactly they're impacting the body. A new one looking at what's known as stomach paralysis, or that is the stopping of processing of food in the stomach. Meanwhile, there's also been another recent study in the last few weeks looking at the digestive tract and sort of stopping the function there. So while these drugs do slow down, the digestive process, they could slow it down too much. And so those are some of the concerns that are coming to light, adding to the additional side effects we know that are continuing to be monitored.
Anjali, thank you so much for that. Walmart raising concerns about the popularity of these weight loss drugs like Ozempic and Wegovy on its bottom line. The retail giant saying it's seeing consumers pull back as some analysts warn of bigger issues for food companies as a result of the drugs. Joining us now is Bert Flickinger, Strategic Resource Group Managing Director. So Bert, let me ask you this. If you're an investor watching right now and you have money, you put it to work in fast food chains, candy makers, Bert, should you be worried about the popularity of these appetite-suppressing drugs?
No, Josh, and you and Anna Lee just synthesized it very well, referring to the Jefferies research. There is no GLP-1 jail. So there are only a few million consumers on these drugs. There are significant concerns in terms of side effects, most of them gastro, and the weight population in terms of the CDC, people percent overweight and or obese has doubled in children, adult women, and adult men during the last generation. So there's plenty of room for weight loss drugs, and there's plenty of room for better nutrition, exercise, health care, and especially private label products from the retailers like Walmart, Kroger, Costco, that have better products at much more competitive prices, that people can get good nutrition and live much more healthfully going forward without the risk of drug side effects like the GLP One drug's side effects that you and Annalee just reported.
Hey, Bert, it's Julie here. It's good to see you. You mentioned Walmart. Walmart, head of U.S. operations, making headlines yesterday for saying that the drugs are having an effect, according at least to their data. Do you think they're just making excuses or preparing the street for a hit to sales here?
Julie, your retail instincts are the best of anybody in the industry, and you're right again, because Walmart's slowing is 60% of consumers are paycheck to paycheck, cash to credit constrained. Crop year prices during the last 2 ag years have cut in half. National brand manufacturers haven't lowered the prices. Walmart's getting the benefit of inflation, but like Dollar General, like Dollar Tree, like Target, Walmart's missing the numbers. So companies like Target are on Yahoo Finance near a 52-week low, while Novo Nordisk, which I'm also a shareholder as well with all the retailers, stock has doubled during the last year. I think there's, to quote Alan Greenspan, a little too much irrational exuberance. Jeffries has also reported on GLP-1 drugs. Walmart, Target, Costco, Kroger will all do well in the future, but the GLP-1 drugs will not have a meaningful effect until the second half of this decade, not the first half of this decade.
Yeah, but I meant to ask you, in here we're not talking about traders, we're talking about investors who put their hard-earned money to work. Yeah. If you're in a packaged foods business here, let's say you've invested in a Hershey's, a Hostess, something like that, Bert, I realize there are limits to these drugs. You talk about access and affordability and side effects, but there have also been a lot of talk about it. What I've read is surging popularity. Does it need to be on your radar, do you think, Bert, if you're a long-term investor, before you're committing capital to some of these companies we're talking about here?
Josh, you're completely correct, and very important, as you cited. Intermediate to long-term investors should be aware of the side effects of the drugs. And to your point, the national brand manufacturers, in my professional view, have been price gouging during and after COVID more than any other part in U.S. history, where we've studied at Cornell University, where I teach in the College of Agriculture and Life Science and study food pricing. So the national brand manufacturers have to watch out for the private label manufacturers, the retailers' own brands, because just like England, Ireland, Scotland, and Canada, as you know well, Josh, as does Julie, private label will go from 25% to 35% to 50% of unit sales. And as Aldi and Trader Joe's have taught us, the quality is as good or better, and Kroger's and Costco are doing a particularly good job there. So the retailers are investable, the drug chains are investable, and the national brand manufacturers, to your great point, Josh, invest with caution, intermediate term, okay, long term, maybe some uncertainty.
So in other words, it sounds like, Bert, it is not a zero-sum game when it comes to, the success perhaps of the GLP-1s versus, or not versus, the food companies. Bert Flickinger, it's great to catch up with you. Thanks so much for being here. Appreciate it.
Always great to team up with you and Josh, Julie, and Rachel, and Anna and Ellie and your great team. Thank you.
Thanks. Talk to you soon, Bert. Coming up, the closing bell on Wall Street. We're checking on the latest market moves and the top trending tickers. Stay tuned. on Wall Street. Let's do a quick check of the markets here on what was a little change day for the major averages. Last time we checked in, they were slightly in the green. Looks like they're ending the day very slightly in the red, with the S&P and the Nasdaq down just about 0.1%, and the Dow very little changed as well. Similarly, we've been talking about the driving force being the Treasury market as of late. Not seeing much change in Treasury yields today either, and so the two asset classes kind of reflecting each other, seeing a little bit of a pullback in yields, but very small today, along with the downdraft in stocks. And in terms of what was underperforming today and what ended up pulling stocks lower in the day, Coca-Cola played a role, one of the worst performers on Wall Street and closing near a 2-year low. Consumer staple stocks overall have been under pressure. Analysts are warning about the effects of weight loss drugs like Ozempic, causing shoppers to buy less snacks and food perhaps. Also, the strengthening dollar potentially causing some headaches for these U.S. multinationals when they bring that profit back home. Josh, if I take a look at the sectors in the S&P 500 today on the Wi-Fi Interactive XLP, that is the consumer staples ETF, far and away the worst performer of the major averages, along with materials here, real estate and healthcare faring a little bit better here. And then if you look at the individual food stocks, here they are on the day. You've got Coke there, but Pepsi also down even more. Mondelez down 5%. As we were just talking about with Burke Flickinger, is this thesis valid that there's going to be less demand for this stuff? It's questionable, maybe.
Yeah, a lot of challenge. As Bert was bringing up, I mean, access, affordability, side effects, there's a lot of challenge. I think with staples, too, today, as we were talking about, Julie, it could be, listen, it's higher rates and maybe some worries here about the consumer and the economy. ConAgra also reported missed on sales, so not great for the staples either.
Right, exactly. Yeah. So a lot of different factors here. And maybe people liking to point the finger at the GLP-1s as the culprit, but maybe the picture's a little more complex.
Yeah, always is. BlackBerry under pressure today on news it plans an IPO for its Internet of Things division. It's the part of the business focused on adding online capabilities into appliances like cars and everyday items. So BlackBerry, of course, used to be a cell phone giant, now a security software provider. Spinning off this IoT business, Internet of Things, analysts value that IoT segment at $1.7 billion. And some analysts did like the news, but investors not so much.
Man, this is the season of spin-offs, is it not? We have had so many
Kellogg,
splits and spin-offs happening over the past week or so. So this is just the latest. BlackBerry actually began this review back in May. Its review of this business. It's only about a, $2.5 billion company total at this point. Yep. So interesting that it is doing this spin-off. Initially, when it announced this after the close yesterday, or maybe before the open today, the stock initially went up before the regular session and then ended up going down. And in fact, just anecdotally, these spin-offs that we've been watching in the last week or so have been punished when they are enacting the spin-off, or in some cases when they're announcing the spin-off. So it seems like, it's unclear if it's just a general risk aversion or if it's specific to this decision that BlackBerry has made.
Tough day for BlackBerry and tough year, too, for those investors.
Yeah, and then there's one more automaker that we are watching today. That is Lucid, in addition to GM, which we talked about earlier. Lucid announcing that it's going to offer a new, cheaper version of its luxury Air sedan. Investors don't seem pleased with that. The EV startup's new version has rear-wheel drive, starting price of $77,000, about $5,000 less than the current low-cost option. You can see the shares are down about 7%. It's a luxury vehicle, and you're not even getting the all-wheel drive. It's unclear to me if this is exactly why the stock is down so much. Yeah. Like Rivian, this is one of those where there are just a lot of questions about the profitability.
Well, you mentioned Rivian, which is a good point, because I wonder Rivian getting knocked around. I wonder if that's a domino kind of a ripple effect, maybe pulling Lucid. And also, listen, when you bring out a relatively cheaper product, some investors might get nervous about what does that say about demand potentially. So maybe that's weighing as well.
Yeah, it
rough session, down 7%.
Yeah. Well, let's turn back to the fixed income market. A little bit of relief today, but Treasury yields are still trading near 16-year highs, weighing on stocks and triggering risk aversion across markets. Our next guest says, don't look to the traditional buyers of Treasuries to stem the selling tide. Let's bring in Joseph Wang. He's Monetary Macro Chief Investment Officer to discuss. Joe, thanks for being here. This caught my eye when you posted about this on Twitter and you wrote about this as well. You blogged about this. So basically what we've been seeing is yields go up as there's been selling in the Treasury market. In order for the yields to come down, you're going to need to see more buyers come in. Are those buyers going to come in at some point, and what would trigger them to do so?
Well, first of all, thanks so much for having me. And you're exactly right. That's what's happening right now. So at the end of the day, at a high level, what matters is supply and demand. And as we know, the U.S. Treasury is basically going to issue $1.5 to $2 trillion worth of debt every year for the foreseeable future. And we've never issued that much ever consistently. So you got to look at what the demand is. Now, demand doesn't look good, especially from those people we would traditionally think as buying. So until recently, the marginal buyer of Treasury debt was the Fed, obviously, doing Nasdaq QE, and the commercial banks, actually. They were buying hundreds of billions of dollars. But then they all stepped away last year. So who was the marginal buyer after them? It was actually the hedge fund community. They were buying hundreds of billions of treasuries as part of a cash futures basis trade. And from my research, it looks like they're not buying anymore either. So who's going to step into this vacuum? And the problem is, I don't really think there is anyone, and that's why yields are drifting higher. Now, traditionally, as you know, we would think of people like pension funds or insurance companies that might potentially step in. After all, those guys have a lot of money and they like conservative investments, right? But when you actually look at the data, you'll see that they have never been very big investors in treasuries, even before the great financial crises when treasury yields were pretty high. Those guys have actually preferred very different assets. If you are a pension fund, you actually, strangely enough, buy a lot of equities. Now, as we know, if we look at the public pension funds, they are seriously underfunded. And so I think they've been buying a lot of equities and private equities and alternative assets, not a lot of treasuries. The life insurers, another big pool of potential buyers, they buy almost entirely fixed income, but not treasuries, very, very little treasuries. They buy a ton of corporate bonds. And I think the reason is that at corporate bonds, we see treasuries, the 10-year go up towards 5%, but if you're buying a corporate bond, you can get another 2% on top of that. It still always makes more sense to buy these spread products rather than treasuries, and that's what they do. So I think we're in a very dangerous period because I don't see any clear marginal buyers stepping up. And I think there's a really good chance that we would drift higher and maybe yields spike higher like the repo market in 2019.
So the implications of all of this, if I'm, either a normal investor or just a normal consumer, I'm already seeing higher mortgage rates, higher financing costs for if I want to purchase a vehicle, for everything, right? So what does this mean? What are the implications then if you don't have these buyers coming in to buy treasuries? What then is the ceiling for yields?
So that's the question right now. I think what will happen, well, first of all, the implications directly is that as yields go higher, that's going to be pretty negative for the economy and for the rest of the financial assets. Now, as yields go higher, we can think of as people maybe, instead of buying equities, maybe they'll buy some fixed income. And of course, as yields go higher, if you are someone buying a house, your mortgage rates are going to stay very high. If you're a company that eventually wants to refinance its debt, you're going to have to pay higher rates too. So I think that's going to be a drag on the economy and eventually push us towards recession sometime in the second half of next year. Honestly, I think yields top when the Fed steps in because there really is no other buyer available to buy all these coupon treasuries other than the Fed. Now, you can have some big accident in the markets forcing a big risk-off play, but longer term speaking, I think the only game in town is the Fed as someone that is more active in the markets. Maybe something along the lines of like the Bank of Japan. We're not there yet, but I think that is the ultimate end game for monetary policy here.
So this is really interesting, Joseph. So what you're saying is it's not that yields stop going up when the Fed stops raising rates. That's been something that people talk about. It's when the Fed actually comes in and starts buying treasuries again?
I believe so, yes. I think that, like I said, I look at things through the lens of supply and demand. And from my analysis, the demand is really maxed out at this point, but the supply is, for all intents and purposes, infinite because we have a significant fiscal deficit that only grows larger. So eventually, I think yields start topping out when there's more active involvement by the Fed, not by cutting rates, but actually being actively involved in the treasury market as a buyer.
And so do you think then that, the consensus at this stage seems to be indeed that the Fed's going to start cutting rates maybe in the second half of next year? That's something the dot plot has seemed to gesture at as well. You think it's more likely that they will come in and do this kind of action versus a straight up cut, or would they come sort of in tandem?
So I think I view these two actions as separate. I think that when they go and maybe perhaps buy treasuries or even stop quantitative tightening, I think they will view it as more of a market functioning aspect, as in, there's some technical matter, maybe we have to go in and fix it and it will be okay. Similar to what they did with the repo market in 2019. So repo rates spiked tremendously and they added some facilities and added some liquidity and thought the problem would go away. When they're actually adjusting the overnight rate, like you mentioned, that's changing the stance of monetary policy. I think they'll perceive that to be something separate. And yes, I agree that they will be cutting rates sometime next year as the economy slows and as inflation gets under control. But I would view purchases in the Treasury markets as separate from changing the stance of monetary policy.
Joseph Wang, really fascinating stuff. Thanks for breaking it down for us. Joseph Wang, Monetary Macro Chief Investment Officer. Thanks again.
Thanks so much for having me.
The Biden administration is shifting its strategy on immigration. It will restart deportations to Venezuelan in effort to reduce record border arrivals. This comes as the administration waives federal laws to permit more border wall construction in southern Texas. Here with the details and what this means for President Biden, we have Yahoo Finance's senior columnist, Rick Newman. Rick.
Hey, guys. Right. Surprising turn of events here. So the news just today, the Biden administration is going to begin flying Venezuelans back to their home country if they can't demonstrate that they meet all the requirements for residency here in the United States. And then right before that, earlier today, we got news that the Biden administration actually plans to complete construction on some portions of Donald Trump's border wall, which sounds like a complete flip, of course, because Biden denounced Trump's border wall. Now, this is not the whole wall. This is just a portion of it, a relatively small portion of it. And the explanation from the White House is that in this particular area of the border where construction is going forth, first of all, when Congress passed the funding for this, which was during the Trump administration, it basically said you must build this wall, this part of the wall, and nothing has changed about that. So they're saying, well, we're just complying with the law. And they're also saying that these barriers make more sense than an entire wall for hundreds of miles along the whole border. But what's really happening here, clearly, Biden has just been taking a beating on immigration. It's one of the areas where he polls worst. And we have had an influx of migrants into the United States. So the Biden administration, shifting course here, realizing they have to demonstrate that they are getting the border under control, because voters don't think it is under control, especially when you have migrants now overrunning places like New York City and some of the West Coast cities, Democratic enclaves. So there's clearly an imperative in the White House to do something about immigration.
And Rick, folks are pointing out, to your point, that when Biden ran against Trump in 2020, he did say there will not be another foot of wall constructed in my administration. So you make the good point. It does seem like a reversal here. Have we heard any Democrats responding to this yet, Rick, including more progressive members of the party?
Yes. In fact, that's one of the things that's driving this, Josh. Since there are now thousands and thousands of migrants in New York City, as one example, the reason they end up in New York City is, first of all, some of these migrants hear that New York is receptive. It is a so-called sanctuary city, which means it does not deport people. New York City also has its own law that says everybody who requests a bed has to be given a bed. And there are just too many migrants for the city to handle. So you've had the mayor of New York City, Eric Adams, and also the governor of New York State, Kathy Hochul, basically imploring the Biden administration do something about this. And Kathy Hochul, the New York State governor, has even been saying, we need to stop immigrants at the border. So you've got the leaders in some, so-called progressive Democratic states sounding like Republicans, because guess what? The border and the migration problem is now literally in their front yard. So I think, you have to say some of the Republicans and the conservatives in these border states, Texas and Florida come to mind. They have been trying to sort of pass this problem on to other parts of the country. And when it is your problem, it's a real mess. And suddenly you feel like there needs to be a better way of dealing with this. Just final point I guess I'll make, Josh, is Congress refuses to deal with this. There are many proposals on the table for immigration reform that would do different things to try to deal with this problem. Congress just doesn't do anything. So every administration that comes in has to deal with it at the executive level. And Biden is now learning what a headache that is.
Rick Newman, thank you. Thank you for all of that, Rick. Appreciate it.
Bye, guys.
Up next, diploma dilemma. Will artificial intelligence make having a college degree less valuable in the future? Our next guest seems to think so. Stay tuned. The Securities and Exchange Commission suing Elon Musk in order to force him to testify in its investigation into Musk's purchase of Twitter last year. The agency is looking into whether Musk violated securities laws when making the deal. The SEC said Musk failed to comply with a subpoena to appear for an interview last month. Not a huge surprise here, Julie. Maybe when you think about the history between these two, Musk has fought with the SEC a lot over the years using language that I'm not going to repeat because I think my 4-year-old may be watching, but these two have often gone at it. He's made his views about the SEC very well known. So a long history of bitterness between these two.
Well, you know, it's his fights with regulators that led him to have to buy Twitter in the first place. He lost in court, and that's why he ended up having to go through with his purchase of the company. So now the Securities and Exchange Commission has reportedly said they've asked him to testify a bunch of times. He hasn't done it. And Alex Spiro, who's an attorney for Musk, is saying the SEC has already taken Mr. Musk's testimony multiple times in this misguided investigation. Enough is enough. At least that one is clean. At least that statement is.
Yeah, we can read that out loud.
Yes,
yeah.
Exactly. But this, as you say, is just the latest in the complaints between the both. I mean, the ironic part of it all, of course, is that in the end, Musk didn't want to go through with the purchase of Twitter, and even to this day may be regretful that he bought it. Who knows? Because it doesn't seem to have gone so well for him since he took it private in terms of advertisers leaving the platform and all kinds of other tweaks he's been making. Just the latest change he made today is saying that news organizations' headlines for stories won't be visible in tweets that they attach to posts to their news stories. So,
and of course, brought in Linda Yaccarino
Yes.
as the CEO. But you wonder, Julie, when you watch Musk on X, the platform formerly known as Twitter, he weighs in on every issue. I mean, political, cultural, economic.
Yes.
You do wonder, does that help or hinder Mr. Yaccarino's efforts here to bring back advertisers?
do you wonder?
I don't know. I put it up there as a wonder.
Sure.
Moving on, AI is going to make a milestone of education, earning a degree less valuable when it comes to job hunters in the future. That's according to the CEO of LinkedIn, Ryan Roslansky, has said as the world becomes accustomed to generative AI, the needs for employers will change and more human skills will be the biggest selling point on a resume. It comes as a new study from the network shows hiring in the U.S. is down 24% this year, and job posts mentioning ChatGPT have increased 21 times in less than a year. Joining us now is Karen Kimbrough, the LinkedIn's chief economist. So, Karen, we talk a lot on the show about how much interest there is in AI, the boom of curiosity in technology, the way big tech companies, of course, have been putting a lot of time and effort into this technology. I'm interested from your post, how do you think AI is impacting and changing the labor landscape?
Yeah, sure. Great to be here. Well, one of the things that we're seeing is absolutely the focus on how quickly jobs are changing. You know, we look at the data we have at LinkedIn and we can see what the skills were required for a role, say back in 2015, and compare it to today. And, you know, it's really astounding. Almost 25% of the skills required have changed just in the last 7 or 8 years. Most of the skills that are changing are digital skills, and that just speaks to the pace of technological evolution. So back to your question, what it really means is that we're going to need to be lifelong learners. We're going to need to kind of continuously update our understanding of technology. Doesn't mean we need to be coders or experts, engineers. It just means we need to understand how to use technology as a tool, as a collaborative tool for ourselves at work.
Does it mean that lifelong learning doesn't need to start with a traditional 4-year degree? You know, I was just talking to my husband last night about where we stand with the kids' 529s. Maybe we should just stop doing it.
Well, I get what you mean. I think the way I would put it is that there should be multiple ways for us to continually educate ourselves and stay current as technology evolves. So it just means that it's not enough to go off for 4 years and learn everything you need for the career for the rest of your life. You should expect that you need to kind of continually upskill. And by the way, at the same time that we're sort of wanting to upskill ourselves on the technical side, maybe understanding how AI could be used, if you are an architect, if you're in construction, if you're a project manager, you also want to think about your human skills, those people skills that really let you bring the best of your creativity, your perceptiveness, your sense of ethical trade-offs. All of those are critical skills that are as important as the AI skills.
And Karen, on your platform, LinkedIn, it does look like recruiters are more interested in AI. They're looking for more people with that skill set. How is LinkedIn leveraging that? What tools are you giving recruiters so they can find that perfect applicant?
Yeah, absolutely. So we're rolling out a whole host of new tools that are helping recruiters, basically, honestly, job seekers, professionals, and recruiters get smarter, be more effective and efficient at finding that perfect match. So that could mean everything from how do you craft that introductory email for outreach or the response? How do you craft a profile if you're a job seeker that's going to highlight the best of your skills? And how do you effectively sift through all the opportunities of jobs that we have on our platform and all the talent that we have on our platform to really create that best match?
What are the implications then for the broader economy in all of this, right? In the so-called AI revolution, especially since it still feels pretty early here, but what's the big takeaway?
Right. I love that you asked this question. It is really early. I think we're in the exploratory phase. Everybody's aware of it. There's a little bit of hype around it, We acknowledge that it's important, but we're not quite sure what are the best ways to, engage. And it depends really specifically on whatever occupation or role you're in. It's going to be different for me than it is going to be for you. But what does it mean for the economy? It means that skills are going to evolve more quickly over time than they have in the past. The skills that you need for a job today are not going to be the skills that you're going to need exactly 5 or 10 years from now. It means that the workplace is going to be more dynamic. People are going to invest in their own learning. They're going to expect their employers to help them upskill. And it also means you're going to have more opportunities to use these skills across a wider range of roles. It's not a career ladder anymore. It's kind of like a career ecosystem or a career net where you can go in many directions. So I'm expecting a lot more dynamism actually in the labor market going forward.
I'm trying to figure out if all of this means the death of expertise, Karen, in some ways. I mean, I know you talked about being a lifelong learner, but does that mean it's sort of a mile wide and an inch deep about things that you know about because you're switching jobs all the time? I don't know. I'm just trying to wrap my head around all of this.
I've been thinking about the same thing too, actually. And here's what I think. I actually think that expertise is going to become more important. So for whatever reason, I've been stuck on the example of the travel agent. So there was a time back in the day when you found on the main street a travel agency on every block. You don't see that so much, but there are still travel agents out there who have expertise in crafting the perfect trip. And so I think what we're going to do is you're going to find that over time, expertise becomes more important in roles, not less. And so, yes, we're going to need to kind of stay current with learning, but think of it more like you're updating your smartphone every once in a while, learning new features. It's not that you have to completely program your phone, but you need to learn how to use it and adapt with the updates. I think it's the same thing. We're going to lean into our expertise. We're going to lean into skills around communication, negotiation, collaboration. But we're also going to need to remain technically literate and competent, and that's going to apply to all roles. We think most roles will be touched in a way by AI, not displaced, not replaced, not eliminated, just touched and influenced.
Karen, interesting stuff. I'm sure we will touch base once again on all of it. Karen Kimber, appreciate it.
Thank you.
Coming up, we're going to go around the horn with some of today's most interesting stories, including a new Michelin guide that will rank hotels. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome back to Yahoo Finance Live. I'm Brooke DePalma alongside Ali Canal and Josh Schaefer. We're taking a closer look at 3 of the top trending stories. And I'm starting with one that we talk about often. I guess you could call it X, formerly known as Twitter. Well, they're making some changes to the way that they share media conversations, or articles rather. They're taking away the headline that appears on a photo of the article and instead just keeping simply where it comes from in the bottom left corner. And really, this is just the latest change that we've seen come to the platform. And in a tweet in late August, Elon Musk hinted at this change. He said, citizen journalism is the path. And this is actually a tweet from October, but he said, citizen journalism is the path to a better future. I strongly encourage people around the world to post news about events as they're happening, both text and video. Elon Musk has really been driving users to encourage to share their own conversations. He has admitted that he doesn't necessarily always read news articles, but that tweet in August, he said that this change is coming from him, and he said this will greatly improve the aesthetics.
Couldn't disagree more.
Really?
It makes I mean, they haven't really made a positive change to what was Twitter and is now X, really, since Elon took over, and this is just another version of that. Why is it helpful to not see a headline? What does that do for me as a reader? Because there are so many pictures that people use on the internet that you want to see the headline with in order to put the photo in context. It doesn't really make sense. No one, I don't think, from news organizations is putting a photo out there that isn't meant to go with the headline, right? It's a package deal that we put up on our website. They're supposed to work together, not be taken out of context to just have random photos. I just don't understand what the point is.
Yeah, I don't either. I know it's the aesthetically pleasing side of things, but it feels like with all the issues at Twitter, this isn't number 1 on the list. I mean, advertisers, that's still a really big thing that Twitter needs to work on getting back, which, you know, at the moment, they're struggling on the ad side. So it just feels like this doesn't help that argument, especially when I think I just called it Twitter, X. X has just been this platform that has been associated with fake news and has created a harder environment for journalists and for news organizations. And this seems like another hurdle when it comes to that. Yeah, I did find myself clicking, wondering whether or not this was an image or an actual news article. So I think it'll take some getting used to as well.
Yeah.
As always.
I think they might need AI to help them out, figure out. That's the story I've been watching. AI.
Of course.
AI actually creating jobs, potentially not taking away jobs. This is a new study out from Fiverr saying that they've seen a 10,000% increase in the last 6 months on searches for AI content editing jobs. So this is someone that comes in and edits something that was produced by AI. So AI does sort of the groundwork. Then this person comes in and edits essentially what the computer did. Interesting to see that a Fiverr representative had told one of the news outlets that the job typically pays at about $100 to $125 per project, starting there. I think this is just fascinating because it's what I've been saying about how you can see AI being useful for people to create more jobs or at least create opportunity, right?
Yeah.
Use AI to your advantage.
Yeah.
Let it do something for you and then come in and edit it. I already know friends that do this with work emails.
100%.
You can use AI to basically write a communication for you, then go back in and edit it, but it can cut down time on doing things if you use it to your advantage.
Yeah, and the gig economy aspect of all this as well. I mean, this is a great side gig. I'm like, should I be a editor? Like, I could do it. $125. Like, I'm sure it doesn't take that long, depending on what the projects are. But yeah, it's very interesting to see how, there's all this doom and gloom surrounding AI, and I do think there are opportunities out there to really leverage it.
Yeah, and as you were saying, employees we saw Walmart internally, they're beginning to use AI in internal memos. And really, when you think about the opportunity this could be for a platform like Fiverr, this is bringing more audience to them. People want to work remote right now, and this is bringing yet another opportunity for employees to work remote. And I think that, what we're seeing here is definitely a change in scope of how people think about freelance opportunities. This is something that maybe definitely wasn't around a few years ago, but different experts that I speak to, they just said this presents so many different opportunities. AI does, not only are we seeing now with freelance, but we're also seeing a real estate boom in San Francisco, AI companies looking into their employee in person. So I think that AI has multiple different facets that we have yet to be seen, and we're just on the crux of that.
I think the content editor is going to be reading some funny stuff if you're editing AI, right?
Oh, yeah.
That's someone I want to interview. Like, how bad is it?
That's a great story.
How bad is it sometimes, like, what it writes originally when you're reading through, there's got to be some funny stuff in there.
But even now we hear more like college students, college essays, and just the apparentness or rather awareness that you can tell if it's AI. And so what does this layer then add to it when you add a personal touch to it, when you actually have a person behind the screen sort of interrupting with AI and going from there? I think that it's, once again, yet to be seen, the true effects of this.
It reminds me of when I would take different languages in school, and if you did it in Google Translator, it was always wrong. Yeah. And you had to go back and make sure and edit it, and so it's sort of
failed multiple Spanish homework assignments.
I was not a language girl, and every time I would do it, I'm like, I know this is wrong. I can't do this.
You're like, oh, I wish it was more helpful.
Exactly, but like we were saying, AI can serve many different purposes. One could be to help plan your trip. Maybe you want to look at some hotels, and on the hotel beat, the Michelin star could be coming to hotels now, or is coming to hotels. This is really interesting, not just with the restaurant game, but the Michelin Guide is putting a key to different establishments and hotels based on 5 different types of criteria. 1, having local character. 2, individuality. 3, excellence in architecture and interior design. 4, top service and comfort. And 5, a consistent value for your price. Now, it's to be determined whether you're going to have multiple keys. Right now, hotels mainly operate on a star system. 1 star, 5 star is the best. But for now, it's just 1 key. But this is another way that the Michelin world is sort of trying to take over the travel sector. I know you're not. Are you against it?
Do you guys use Michelin?
I mean, I respect it. I do.
Oh, sure. I mean, like a Michelin star restaurant is good.
Yeah.
It'd be cool to say, I'm going to a Michelin star restaurant tonight, but in terms of hotels and travel, we were talking about how social media
plays such a big role.
Especially TikTok.
It's the only thing I use.
Yeah.
Like, I use reviews on mine, sure, like you always want to read the reviews, but generally speaking, before I go to a restaurant or if I were to go to a hotel or something, you just want to see videos online. You just want to see people posting videos and photos online and just see what it looks like.
And get their take.
And get their opinion. Like, I don't need people giving out stars anymore. We don't get magazines. Like, we just don't need things like this that I feel like are a little bit archaic in some way.
See, I'm going to play devil's advocate here because I feel as though a Michelin star is anonymous. So this is a real take on a person that maybe isn't a big influencer, doesn't have a huge following. I feel like the problem that we're facing with the influencer culture is that they make everything seems so great.
Sure.
And I feel like I fall for things sometimes because I went to a restaurant or went to a hotel that they made seem amazing. But this is going to be the honest take. And I'm excited for it. And I think that'll bring a breath of fresh air. I mean, you read customer reviews, you read things like that. But this is going to be a thorough review of a hotel. And we could find some real gems here. Allie, you just got back from traveling.
I just got back from traveling.
Yeah, but you could find some real gems.
Yeah, I totally agree with that. And you were just saying how the star system is a bit archaic. I tend to agree with that too, because sometimes you can stay at a really nice hotel that's 3 stars, but then if you stay at a 4 or 5 star hotel, it might be a little disappointing because your expectation is so high, and you would think that the threshold for a Michelin-rated hotel has to be even higher.
Right.
Are they on Instagram and TikTok?
Michelin?
I should have answered that question before we came on air, but that's what I'd like to see
the
from them.
Fed is on Instagram, so Michelin,
like Brooke said, an unbiased person doing those Instagram reels would be interesting, though. That's my pitch.
Like a invisible person
behind the scenes.
Yeah, with like they change their voice. Ooh, I like it. Okay.
A lot of big ideas coming out of this group.
All right, big ideas coming out of this group. We'll be right back on Yahoo Finance. Stay tuned for more on the other side of this break.
For the second quarter in a row, we have an earnings disappointment from Levi Strauss, watching the shares fall by about 3% after the company reported third quarter earnings that missed Wall Street's revenue expectation. Another big headline, the denim maker cut its full year sales guidance, and it is the same thing to blame that was to blame back in July when it came out with negative numbers as well. The wholesale channel is really suffering. The direct-to-consumer doing okay, but wholesale through other channels is just not as strong, Josh.
Yeah, and I thought the CEO's comments, Julie, to Bloomberg, were also interesting, saying the middle-income consumer and below are definitely being impacted, especially in the U.S. and parts of Europe. The consumer, this executive saying, is really feeling squeezed. I think maybe plays into some of what we've been hearing this week from different economists and strategists. There are these storm clouds brewing for consumers that we talk about, the rising energy prices, the higher borrowing costs, and, of course, resumption of federal student loan payments. You know, you'll see, and by the way, Levi's, of course, the first big U.S. apparel retailer to report this earnings season. So some investors probably looking ahead and thinking, what does that mean for Macy's and Gap, et cetera?
I mean, earnings season never ends at this point. It feels like we just heard from the big crop of retailers like at the end of August, and now we're getting Levi's here. Just to give, I don't want to bog anyone down with numbers, but that important number that is the net revenue forecast for the full year, Levi's is now saying revenue this year will be flat to up 1%. It previously had seen an increase of 1.5% to 2.5%. And again, a lot of that coming because of weakness in the wholesale channel. Its direct-to-consumer revenues were up 14%, but wholesale revenues were down 8%. It's still seeing what it saw last quarter as well, weakness in the Americas and in Europe, more strength in Asia, but really quite a patchy picture overall for the likes of Levi's.
All right. Well, in recent weeks, stocks have been struggling to shake off the downbeat mood that's increasingly hanging over markets. New survey out from KPMG found CEOs remain confident with the overall growth of the economy, but they're not necessarily optimistic when it comes to their own company's growth. KPMG U.S. Chair and CEO Paul Knopp joined Yahoo Finance's morning show to share insights from these CEOs. Let's listen.
Well, I think, first of all, we're getting more clarity on the duration of what we're facing into. So more clarity around the fact that rates are likely to be higher longer. And also, undoubtedly, inflation is going to be sticky. So inflationary pressures on food costs, on energy costs, certainly on labor costs are going to persist, it feels. So I think that's what's maybe causing some of the subdued confidence of CEOs for growth prospects going forward. And we also see, though, that CEOs are still wanting to put as their top priority generative AI. So 72% of CEOs said that that was their top investment priority, continue to invest in their ESG strategies. And interestingly, although market conditions need to stabilize, 54% of CEOs said they're interested in transformational growth for the future, largely through inorganic M&A.
Does subdued confidence for growth, does that translate into additional restructuring? Are we looking at another wave of headcount reductions, which we had thought we'd gotten behind us to this point?
No, not necessarily, because I think that if you look at the overall data, 77% of CEOs are still confident about the growth prospects of their companies over the next 3 years. So there's a lot of resilience and there's a lot of confidence in the business models CEOs have. I think we're all just trying to determine, how do we navigate higher for longer interest rates? How do we deal with uncertainties around inflation outlook? And that is causing us to dust off playbooks we haven't used for 20 or 30 years to try to ensure we know how to operate in that kind of environment.
Are majority of CEOs, are they bracing for a recession? I guess, how has maybe the last couple of months and the fact that we have seen this surge in energy prices recently, how that's playing into the recession probability?
Yes, I think for the last 12 to 18 months, we've all been trying to prognosticate whether a recession is coming or not. And if you'd asked me 6 months ago, I would have predicted probably not. I think there's a little less clarity on that right now. I think if there is one, the duration should be fairly short and not overly severe. But I do believe that there's still a lot of fog on the horizon, and it's really hard to know whether a recession will hit. Now, what I would say, though, is that we probably have had many kind of sector-based recessions that affect various types of industries over the last 2 years. But the probability of an overall recession for the U.S. economy is still hard to predict.
You mentioned the spending into AI. What do CEOs right now look at as the barometer for whether or not their AI investments are actually paying off?
Well, I think that we have to all realize that the investments are still at a fairly nascent stage at the moment. Sure. So there are really two kinds of investments: investments that can help you transform your business model, and investments that help make you more efficient, transform, if you will, your operating models. So at this stage, it's largely around ideation, but a recognition that we need safe and ethical uses of generative AI. But at the same time, what business leaders are telling me is that every model that's been produced of generative AI, that the next one is multiple times better. So we're recognizing the technology is amazing, and 72% of CEOs saying that it's a top priority for them from an investment perspective means that this is not hype. It's going to be a reality, that we are going to see increasing use cases of generative AI in many different industries. We think it'll be disruptive, and I think you see that reflected in the survey too, where many CEOs said it's a trend of disruption that they're going to have to pay close attention to.
When we talk about investments in AI, and we started to see this in the most recent quarters in earnings reports, it certainly has almost transitioned into a show me story. Investors, shareholders want to know how quickly it's going to impact the financials of the company. What did you learn, or have you learned there, just in terms of how quickly some of these companies that are investing or plan to invest in AI, when we'll see that return on investment?
I think most business leaders, CEOs, believe it's more of a 3 to 5 year horizon. And certainly there are going to be some near-term impacts, but 1 to 2 years out, there'll probably be somewhat meaningful impacts. But I think the real investments they're making will pay off in 3 to 5 years, and that's what the survey reflected. And we certainly see a tremendous amount of investment in this space. We are investing with Microsoft, Google, Salesforce, and others in this space, and we see our competition doing the same. And we also see co-development of solutions. So I think that will accelerate bringing those solutions to market as we put together some of our capabilities with the technology capabilities of these companies.
Well, I think at 3 different points during this show, we've talked about some of the disarray in Washington, D.C., and particularly what that spells out for a general election year in 2024. How are CEOs positioning themselves, their companies, and planning for what the reality of that may look like for their businesses, too?
Well, Brad, geopolitical risk and political uncertainty rose to the top of risks that CEOs are concerned about. There's compounding volatility right now, compounding risk in the market. We certainly as a business community are watching what's happening in Washington very closely. We're concerned about the trajectory of potential legislation in the future and how some of these situations, such as the speaker's situation in the House, the upcoming election, are going to affect not only legislation going forward, but shutdown risk around the government, because those risks are very, very significant to the economy. And so we as a business community are watching very closely what's going to happen and hoping that there is more alignment around progress and around the business agenda in Washington, D.C.
One of the points that you highlighted a few moments ago from the survey was deal-making activity. What you're seeing there, what companies or what CEOs are planning to do within that space. What are some of the top ideas that you're learning from in terms of where you're expecting to see some of that activity take place?
Well, what we know for a fact is that corporate balance sheets are really healthy. And we know for a fact that there is a lot of money in private equity firms and otherwise on the sideline ready to be invested, and many of them are still raising funds. So we know that once price discovery takes hold, once buyers and sellers come to a meeting of the minds around prices, and we start to get more stability in the leveraged finance markets, as well as ensuring we understand what the picture looks like for interest rates, whether they're going to increase anymore, I think you'll start to see deal activity pick up sometime in 2024. A couple of the IPOs recently haven't been real successful, which initially we thought those were green shoots, and now we're having to kind of look at what's really happening in the market. But I think as we go into the end of this year and sometime into 2024, you'll start to see increasing deal activity, but probably not like what we saw in 2021 when the acceleration was really significant.
Our thanks to KPMG U.S. Chair and CEO Paul Knopp. And coming up, it's closing time here on Yahoo Finance. We recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned.
The auto industry is facing its biggest transformation in decades, electrification. And it's not just Tesla shaking things up. The ripple effects are being felt from the factory floor to the driver's seat. And it hasn't been a smooth ride between supply shortages, the auto worker strike, and high prices. The road to broader adoption is filled with speed bumps. Yahoo Finance has the manual on the top issues facing the industry for both investors and drivers in our special series, EVs, The Road Ahead. It all starts on October 9th, right here on Yahoo Finance.
Mortgage rates on the rise again. The rate on a 30-year fixed-rate mortgage hit 7.49% last week, according to Freddie Mac. That's up from the prior week. And a year ago, the 30-year fixed was at 6.6%. As rates keep rising, the freeze is setting in on the housing market. According to the National Association of Realtors, the pace of home sales is more than 20% behind last year at this point in the year. Elon Musk making more changes to X. This time, the company's getting rid of story headlines and links in some users' feeds, essentially making it more confusing for people to get to news sites from the social media platform. And General Motors shares closing at a 3-year low. A Wall Street Journal report revealed at least 20 million vehicles were built with a potentially dangerous airbag part that the government says should be recalled.
And time now for What to Watch Friday. Investors can look forward to the September jobs report. This comes as ADP's report showed private sector employers pulling back their hiring efforts far more than expected. Economists estimate the U.S. will add 170,000 jobs to the economy, a smaller growth than what the labor market saw back in August. Meanwhile, on the union front, United Auto Workers President Shawn Fain to provide an update Friday afternoon for this week, making its 7th offer to striking auto workers as negotiations continue between the UAW and Detroit's Big Three, GM, Ford, and Stellantis. And lastly, be sure to tune in to Yahoo Finance to hear from the Consumer Financial Protection Bureau Director, Rohit Chopra. Will be getting his reaction on what the Supreme Court had to say in the debate about the Bureau's funding structure.
That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow, 3 to 5 p.m. Eastern. All of your coverage leading up to and after the closing bell. Have a great night.